Okay, so set the scene for us.
We're at Columbia Business School, probably the early 2000s. Warren Buffett is there. He's already a total legend at this point.
Hmm.
And he's taking questions from a room full of, super smart, super ambitious MBA students.
And they all want the secret, right? They want the complex formula, the one weird trick, the thing they can say in a job interview that makes them sound brilliant.
Exactly. And a student asks him point blank, what should I do right now to prepare for a career in investing? And Buffett's answer is, well, it's brutally simple.
No complex theory.
None. He just holds up this big stack of paper he has with him. It's annual reports, trade publications, dense, boring-looking stuff. And he says, read 500 pages like this every day.
500 pages. I mean, let's just sit with that for a second. That is a staggering amount of reading. It's like a whole book, a dense one, every single day.
It is. But here's the genius of the advice, the mechanism he points to. He says knowledge works just like compound interest. It builds up on itself, slowly at first, and then it just snowballs.
And he makes this critical point, right? That most people could do it. Physically, it's possible.
Yeah, but almost nobody will. And he says that gap, the gap between could and will, that's where the entire edge is. That's the whole game.
It's not about being the smartest person in the room. It's about being the most persistent.
That's it, exactly. You don't need a 140 IQ to read an annual report. You just need the discipline to do it when 99% of other people are, watching TV or scrolling through their phones. The advantage comes from sheer consistent volume.
And the proof of this, the thing that makes it more than just a nice story, is the tale of Todd Combs.
Right. So Todd Combs was apparently in that room, or at least heard the story. And he took it literally. He didn't hear it as inspiration. He heard it as a direct instruction manual from the best in the world.
Like a prescription from a doctor.
A prescription, that's a perfect way to put it. The sources say he would read 600, 750, sometimes even 1,000 pages a day early in his career. He just saw it as the cost of entry, the work required for the job.
And the result is what matters. Combs eventually goes on to join Berkshire Hathaway as one of Buffett's key investment managers. The line isn't, read 500 pages, make $1 billion. The line is that daily, relentless learning leads to better judgment. It leads to recognizing patterns faster. It means when a great opportunity finally shows up, you recognize it instantly because you've read the prequel a dozen times in other companies' histories.
And that really gets to the core principle here. Wealth is just compounded understanding. And if you think about it, probably the most expensive sentence in all of finance is that little phrase, oh, I already know how this works.
Yeah, that's a killer. Because the rules are always changing. The market evolves, technology disrupts entire industries, tax laws get rewritten. The moment your mind is finished, you become a target.
Right. But okay, let's be realistic here. Reading 500 pages a day is, like you said, basically impossible for a normal person with a job and a family. So how do we translate that core idea into something, actually doable?
That is the key question, because the principle is great, but it's useless if it's not practical.
I think the key is to focus on the intent behind the number, not the number itself. Buffett's real message is about the ratio of proactive learning to reactive learning. Most people live in a state of reactive learning.
What do you mean by that?
I mean, they pay tuition in a panic. You learn about budgeting after you're in debt. You learn about your industry after you get laid off. You learn about investing after you lose a bunch of money on a speculative bet.
It's learning driven by pain, and it's always expensive and stressful.
Exactly. The compounding learner does the opposite. They build a steady pipeline of information and reflection before the crisis hits. They're reading about recessions when the market is booming. They're studying a new technology before it disrupts their job.
So the rule isn't really read 500 pages. It's more like don't chase returns, chase understanding. The returns will eventually find the people who stay curious, even when everything seems to be going fine.
That's it. It's about learning when you're comfortable, not just when you're desperate.
Okay, so let's get into the nuts and bolts. We need the tools, the tactics. How does someone listening right now actually install this habit?
The first step, and it's completely non-negotiable, is what we call the input block.
An input block.
You have to schedule it, a dedicated 30 to 60-minute slot in your calendar. Same time, same place, every single day if you can. And you treat it like the most important meeting of your day. The only rule is no phone, no scrolling, no news headlines, only deep reading that sharpens your financial thinking.
And what you're reading matters just as much, right? You call it the paper diet.
Yes. You have to change your information sources. You have to get off the sugar high of headlines and commentary and move to the protein of primary sources.
So we're talking annual reports, shareholder letters from CEOs you respect, earnings call transcripts, deep business histories.
The boring stuff. This is the
Okay.
boring stuff that other people won't read, and that information gap is where your edge comes from. A headline gives you an emotional hit. An annual report requires actual intellectual work. You have to choose the work.
But just reading it isn't enough. The information has to lead to action, otherwise it's just trivia. So what's the processing mechanism?
This is maybe the most powerful tool of all. It's the one-sentence rule. After every single reading session, you have to force yourself to write down the answer to this question. What did I learn that changes what I would do with my money?
Wow.
If you can't write that sentence, then the reading was entertainment. It was decorative learning, not instrumental learning. It's a brutal but necessary filter.
That is a fantastic filter.
Yeah.
It forces you to find the utility in everything you read. So that's the daily practice. What about when it comes to making bigger decisions? You mentioned something called a thesis card.
Right. The thesis card is the output of all that daily learning. It's a one-page document you create for any major financial decision. Buying a stock, starting a business, even buying a house.
So what's on this card? What does it force you to do?
It has 4 key parts. First, simple. What do I believe will happen? Second, why do I believe it? And here you have to cite your sources, your data, no hand-waving. Third, and this is the one most people skip, what evidence would prove me wrong? You have to define your failure conditions up front.
That's the humility check. That's building the Dalio lesson we'll talk about later right into the process.
It is. It kills your ego before your ego can kill your portfolio. And the fourth part is, what specific metrics will I watch? These are your tripwires. A good thesis isn't, I think this stock will go up. It's, I believe this company's free cash flow will grow 15%, and if it drops below 5% for 2 straight quarters, I will sell. It's specific.
It makes the whole process disciplined instead of emotional. But how do you make sure all this knowledge actually, compounds? It's easy to write these things and then just forget about them.
That's the final step. Systematic review. Once a month, you have to schedule time for knowledge compounding. You sit down and reread your active thesis cards, and you take what you've learned from your daily input blocks that month and see what needs updating.
So you're constantly integrating new data into your old beliefs.
Exactly. That's where the real edge grows. Your knowledge becomes dynamic, not static. So the lesson is clear. You have to systematically compound knowledge before you can hope to compound money.
But okay, all this reading creates a ton of raw data, a fire hose of it. The next logical question is, how do you process it all so that it actually changes your behavior? And that leads us perfectly to the learning machine built by the great Jim Simons.
Yeah, this is a really fascinating shift. We're going from Buffett, who's the master of, qualitative deep business understanding, to Jim Simons at Renaissance Technologies, the ultimate quant.
They seem like polar opposites in their style.
They do, but their core belief is identical. A systematic learning process creates an edge that is almost impossible for others to overcome.
And the origin story of his hedge fund, Medallion, is so revealing. He didn't go out and hire a bunch of hotshot traders from Wall Street.
No, quite the opposite. He hired physicists, mathematicians, cryptographers, people who were trained as scientists. His bet was that the real edge in markets wasn't intuition or a feel for the market. It was building an objective machine that could learn patterns faster than any human could.
It's a totally different question. He wasn't asking what's a good stock. He was asking what patterns are mathematically real and how can I test them rigorously.
And the most telling detail about his whole operation wasn't the fancy algorithms. It was his obsession with one simple thing: clean data.
Right.
If one of his models spat out a result that seemed too good to be true, like a stock magically doubling in a day, his first reaction wasn't excitement, it was deep suspicion. He assumed it was an error in the data.
Because he knew that bad data, buggy inputs, they don't just give you a wrong answer. They corrupt the entire learning process. They can lead you to catastrophic mistakes.
And that right there, that's the hinge moment for his whole philosophy. The magic of Rentech wasn't one secret formula. It was a culture and a machine built to constantly test reality. It prioritized skepticism over confirming what they wanted to believe.
And that skepticism was built right into the human culture of the place, too.
Absolutely. The sources all talk about this intense environment of debate and collaboration. The goal of a meeting was for teams to try and break each other's models, to find the flaws in each other's logic.
Because finding a broken assumption in a conference room is infinitely cheaper than finding it out from the market.
Infinitely. So the core principle here is that real learning has to update your behavior. It's not enough to just consume information. So many of us, we read the books, we listen to the deep dives, and we feel smarter. We feel informed.
It's that decorative learning you mentioned.
Exactly. But if your actual behavior doesn't change, you haven't learned anything, you've just been entertained.
And money is the ultimate, most brutal feedback loop there is.
It is. Your bank account tells you the absolute truth every single month. There's no narratives, no excuses, just the numbers. And yet, what's the default human habit?
Avoidance. I'll look at it later. I'm not really a numbers person.
Right. And that delay, that avoidance, it's a guaranteed strategy for failure because you're actively skipping the most important part of the learning loop, the correction phase.
So the machine mentality is about replacing that emotional avoidance with the cold rigor of a scientist. It's about turning your financial life into a series of testable questions.
Yeah, instead of a vague goal like I want to save more, you have a testable question. If I cut my spending on eating out by $50 a week for 1 month, what is the measurable impact on my savings rate? It's specific.
It's the Simon's loop applied to your own life. Track the data, analyze the results, adjust your behavior, and then repeat the whole process.
That's the engine. Track, analyze, adjust, repeat.
Okay, so let's make this practical. If my machine is just my simple monthly budget on a spreadsheet, how do I apply this level of rigor? What are the tactics?
First, you have to start running your money like a lab experiment. Be intentional. Pick one, and only one, variable to change at a time. Maybe you increase your savings rate by 1% for a month. Maybe you dedicate 2 extra hours to a side hustle.
And then you measure the outcome. You don't just guess if it helped.
You need the evidence. Did that change actually move the needle? If not, you try a different experiment next month. Stop guessing. Start testing.
And for investing, the absolute must-have tool is the Investing Decision Journal.
Yes. Before any significant buy or sell, you have to write down 3 things. 1, why am I doing this? 2, what could go wrong? And 3, what specific measurable evidence would force me to admit I was wrong and change my mind?
And the journal is so critical because it stops you from rewriting history in your own mind.
It totally does. When a trade goes against us, our natural tendency is to rationalize it after the fact. Oh, I knew that was a risk, or I was just testing an idea.
Yeah.
The journal forces you to confront your original, flawed logic so you can actually learn from it.
And none of this works without Simons's obsession. Clean data.
It's the foundation. If your expense tracking is a mess, if you have 3 different categories for groceries, then any analysis you do will be garbage. You have to be ruthlessly consistent in how you categorize and track your finances. Sloppy data guarantees sloppy conclusions.
Once that data is clean, you need the ritual, the weekly review.
20 minutes. Every Sunday night. That's all it takes. You sit down and synthesize the data from the week. What surprised me? What worked? What didn't? And most importantly, what is the one single thing I will adjust next week?
That one adjustment prevents the "I'll just try to do better next month" trap, which is just a recipe for repeating the same mistakes.
It creates a tight, continuous feedback loop. And finally, you have to curate your team. Simon's had his team of PhDs. You need to build your own intellectual challenge team.
And these aren't necessarily people you know personally.
Right. It's the thinkers you follow. But the key is diversity. You need to follow people from different fields, an accountant, a psychologist, a historian. If everyone you listen to is a stock market bull, your own mental model has a massive concentrated risk. You need the person who will challenge your core assumptions.
So the goal isn't just to hope your money grows. It's to build a system that learns, adapts, and corrects itself. But that process, it inevitably forces you to confront your mistakes and your ego. And that brings us right to Ray Dalio's incredibly painful but powerful lesson.
Yeah, this part really gets to the heart of the psychology of money. It's about ego. So we have to go back to 1982. Ray Dalio is not the legend we know today. He's young, he's brilliant, and he is absolutely 100% certain he's right about the market.
He was publicly betting on a huge market crash.
Huge. And his logic seemed sound. He saw that American banks had lent enormous amounts of money to Latin American countries, and he believed that debt was about to go bad. The bubble was going to pop.
So he's positioned for a crash. And then in August of '82, it looks like his prediction is coming true. Mexico announces it can't pay its debts.
This should have been his victory lap. This was the trigger. This was the event he'd have been telling everyone was going to tank the market.
But the market has a way of teaching humility.
Ultimate teacher. The market did the exact opposite of what he was certain it would do. Instead of crashing, it went up. And not just a little bit. In his own words, it went up a lot.
So this wasn't just a bad trade, this was a total blow-up.
A complete wipeout. He lost his own money, he lost his clients' money, he had to fire all his employees. The sources say the failure was so total that he had to borrow $4,000 from his dad just to pay his family's bills.
That's the hinge moment, that rock bottom of financial pain and public humiliation.
It forced a complete rewiring of his brain. He realized the market didn't give a damn how smart his thesis was. The only thing that mattered was what actually happened. So he shifted from this arrogant position of, I know what will happen, to a much more powerful and humble question.
Which was,
How do I know that what I think I know is actually true?
he stopped looking for evidence that confirmed his beliefs and started actively searching for evidence that would challenge them.
And that gets us to the core principle here. The biggest mistakes in finance are rarely math mistakes. They are belief mistakes.
Absolutely. People go broke because they cling to a story about how the world works or how their career works or how smart they are. And if you don't audit those beliefs yourself, life will eventually audit them for you at the highest possible price.
And we cling to these beliefs because it's about protecting our identity. It hurts to admit we're wrong. It feels like a status decrease. So our brain works overtime to defend the old story until the pain just becomes too much to ignore.
Right. And Dalio actually created a formula for how to break this cycle. It's simple but profound. Pain plus reflection equals progress.
Pain plus reflection. Progress. The pain is the market signal that your model of the world is wrong. The reflection is the hard, slow, painful work of figuring out why you are wrong. And the progress is the change in your system or your behavior. The tragedy is that most people feel the pain, but they immediately skip the reflection part.
Which just guarantees you're going to pay for the same lesson over and over again.
And over again. So the superpower here isn't being right all the time. It's getting faster and cheaper at realizing when you're wrong and then adjusting. It's building a system for rapid correction.
So if we want to build this kind of intellectual humility into our own financial lives, we need some specific tactics for doing these belief audits.
It starts with a weekly audit. Just a simple question you ask yourself every Sunday night. What am I currently treating as an absolute truth about my money? Write it down. My job is stable. Real estate always goes up. This stock is a sure thing. Get the unexamined beliefs out on paper so you can look at them objectively.
And then you have to reframe them. You talk about turning certainties into testable questions.
The language you use in your own head matters so much. So instead of saying, this investment will work, you flip it. You ask, what specific event would prove this investment won't work in the next year? It immediately puts you in a mindset of looking for risks, not just confirming your bias.
That leads perfectly to the pre-mortem technique.
Yes. Before you make any big decision, you do this exercise. You imagine it's 1 year in the future and the decision has failed spectacularly. It's a total disaster. Then you write the story of why it failed, what went wrong.
And after you've imagined that failure, you design one safeguard to protect against the most likely cause.
Exactly. You proactively build a defense against your own blind spots. And over time, you should be keeping a mistake library, a journal. But it can't just be, I lost money on X. It has to be more detailed.
What goes in it?
4 things.
Sure.
What happened, what I believed at the time, what crucial piece of information I missed, and what I will do differently next time. This process turns painful losses into your most valuable assets.
And finally, you have to diversify your inputs, your sources of information.
We can't say this enough. If you only learn from people who already agree with you, you're not learning. You're just paying for confirmation bias. You have to actively seek out the smartest people who hold the opposite view. Your knowledge portfolio needs to be diversified, just like your financial one.
The lesson from Dalio is pretty stark. If you don't question your own beliefs, your bank account will. And that idea of questioning everything from the ground up leads us to Ed Thorp, who literally had to teach himself the entire game from scratch.
Yeah, Ed Thorp is such an amazing character. He's famous for writing Beat the Dealer and proving you could beat the house at blackjack, but his story as an investor is just as powerful.
So he was a brilliant mathematician, but he knew nothing about finance, right?
Nothing at all. And he had this money from his book and his gambling winnings, and he did what a lot of smart people do when they enter a new field.
Yeah.
He made a bunch of what he called foolish mistakes. He was just guessing.
But his response is the key. He didn't just throw up his hands and say the game is rigged, and he didn't go hire some expensive advisor to think for him.
No, his response was to buckle down. His words. He decided to teach himself the entire system from first principles. He basically said he spent a couple of summers of reading, just this intense, focused, deep dive to understand how investments actually worked on a mechanical level.
And through that process, he discovered an inefficiency in the market: stock purchase warrants.
Right. And without getting too technical, a warrant is basically a type of option that a company issues. The key for Thorpe was that its price was mathematically linked to the price of the underlying stock.
So it allowed him to turn a messy, narrative-driven problem, is this stock going to go up, into a clean math problem.
Perfectly said. By hedging, by buying the warrant and shorting the stock, he could isolate the mispricing and remove a lot of the random market noise. He wasn't betting on a story from a CEO. He was betting on his mathematical model, using inputs that were readily available to anyone.
So the big realization was that an outsider with no connections could build a real edge just through rigorous, independent learning.
That's the hinge moment. And it leads to this core principle. Independent thinking reduces dependence. Most people lose money because they are dependent on someone else's conviction. A TV pundit, their brother-in-law, a headline. Thorpe's 2 summers of reading was an act of self-rescue.
And it really forces that distinction between decorative learning and instrumental learning.
Yes. Decorative learning is collecting facts so you can sound smart. Instrumental learning is acquiring knowledge that directly changes your decisions and improves your outcomes. Thorpe wasn't trying to sound smart. He was trying to build a system that worked. Only instrumental learning actually builds wealth.
And his ignorance was actually his superpower.
It was. He said that not knowing finance meant he had fewer set ideas going in. He didn't have to unlearn years of flawed Wall Street dogma. He could just look at the problem with fresh eyes and pure logic.
And that deep understanding also gives you something else: the profit of restraint.
That's such an underrated skill. A true learner knows the game so well that they know when the odds are not in their favor. They know when to sit on the sidelines and just not play. That ability to avoid bad situations is a huge tax-free source of wealth over a lifetime.
So let's translate this. What are the tools for someone who wants to adopt this Thorpe method?
First, take him literally. Adopt the 2 summers of reading challenge. Pick one financial topic that intimidates you, taxes, options, real estate, whatever, and dedicate 8 to 12 weeks to mastering it. Treat it like a college course where you are both the professor and the only student.
And as you learn, you have to strip every decision down to its core variables, just like he did with warrants.
Yes, for any decision, you have to ask, what are the 3 to 5 measurable inputs that truly drive this outcome? You have to force yourself to ignore the story, the hype, the narrative, and focus only on the metrics you can actually track.
And then you have to prove you understand it, the ab initio explanation.
You have to be able to teach the concept back to yourself in simple language. The goal is to explain it so clearly that a smart 15-year-old could understand it. If you need to use jargon and complexity to explain it, you probably don't understand it yourself.
And you don't risk real money until you've proven the understanding.
You have to scale your understanding before you scale your money. Use paper trading, simulations, tiny little investments. Get real-world feedback on a small scale before you commit serious capital.
And finally, build a signal filter.
Don't act on any claim until you can point to the primary source document. The 10K filing, the fee schedule, the contract. No evidence, no action. It's that simple.
Ultimately, the Thorpe method is about making yourself harder to fool. And that ruthless focus on evidence over narrative is perfectly embodied by our next figure, John Bogle.
Yeah, the story of John Bogle and Vanguard is just a masterclass in the power of simple, undeniable evidence. We have to go back to 1949. Bogle is a student at Princeton, and he's writing his senior thesis on the mutual fund industry.
So he's not in the trenches of Wall Street. He's taking an academic, research-based approach.
Exactly. And the conclusion he came to, based on just crunching the numbers, was explosive for the time. He concluded that after you account for their fees, mutual funds can't consistently beat the market averages. The math just doesn't work.
So the evidence was clear from the very beginning. Active managers, as a group, were not delivering value for their cost.
That conviction, rooted in arithmetic, became his life's work. But it wasn't a straight line to success. Years later, after a rough market in the early 70s and a failed merger, he was effectively fired from the company he'd helped build.
And that failure, that exile, was the hinge moment.
It was. It freed him from the constraints of the existing industry and allowed him to build something entirely new, based on his thesis. In 1974, he founded the Vanguard Group.
With a revolutionary structure.
Revolutionary. It was structured to be owned by its own funds, which in turn are owned by the shareholders. It runs at cost. And in 1975, he launched the first ever market index mutual fund, A fund that didn't even try to beat the market. It just aimed to match it for the lowest possible cost.
And the industry mocked him for it. They called it Bogle's folly.
They thought it was absurd,
Yeah.
un-American even.
Oh.
But Bogle stuck with the evidence, and over decades, the evidence won. Which brings us to the core principle: evidence over ego. Market fads come and go, but simple arithmetic is timeless. That's the only edge that doesn't expire.
It's all about his blunt maxim. Yes, costs matter.
That's his whole philosophy in 3 words. Investing isn't a game of genius, it's a game of arithmetic. Gross market return minus the cost you pay equals your net return. That's it. Every dollar you pay in fees is a dollar that isn't compounding for you, it's compounding for someone else.
So if the evidence is so overwhelmingly clear, why do so many people still choose the expensive, active, story-driven options?
Because we are wired for narrative. The story of the genius fund manager who can see the future is emotionally compelling. The idea that this time is different is exciting. The fear of missing out is powerful. These narratives sell products.
And they encourage action trading, churning, switching funds, all of which generate fees and taxes that eat away at your returns.
So the process of becoming a mature investor in the Bogle model is a process of constant de-romanticizing. You have to stop trying to be clever and impressive and just start trying to be mathematically correct.
So what are the tools we can use to force ourselves to prioritize this kind of boring evidence over exciting stories?
It starts with a rigorous cost audit. You need to sit down and document every single fee, commission, expense ratio, and tax that is working against your money. You need to see, in black and white, the total drag on your portfolio. It's often shocking.
Then you need to live by the evidence-first rule.
Before any money move, you ask yourself, what is the long-term, multi-decade evidence that this strategy actually works? If the best answer you have is a story you saw on TV last night, you have to pause.
And you need to create an investment policy statement, an IPS.
This is so critical. It's your financial constitution. A one-page document you write when you are calm and rational that dictates your asset allocation, your rebalancing rules, and what you will do during a market panic.
It's a letter from your calm self to your future panicked self.
That's a perfect description. It's a pre-commitment to rational behavior. And along with that, for every investment, you should have a simple why I bought this note. If you can't explain why you own something in 5 simple sentences, you probably don't understand it well enough.
And finally, you have to treat this kind of learning like a non-negotiable expense.
You have to schedule learning, like rent. Dedicate 1 block of time each week to reading something dry and primary. A fund prospectus, a company filing, something that builds your real instrumental knowledge base.
The market doesn't reward stories, it rewards discipline. But even the best, most evidence-based system can become obsolete if you, the operator, stop learning and adapting. Which brings us to our final section on staying teachable.
Yeah, and we're splitting this into 2 parts. First, the modern mindset of being a perpetual beginner, which we can see in Satya Nadella's transformation of Microsoft.
Okay, so when Nadella took over as CEO in 2014, Microsoft was a behemoth, but it was also seen as being a bit stagnant, a bit stuck in its ways.
Right. The success had created inertia. And his defining message to the entire company was this brutal but necessary truth. Our industry does not respect tradition. It only respects innovation.
In other words, what made you successful yesterday is no guarantee of being successful tomorrow.
Exactly.
Yeah.
If you stop learning, if you stop updating your skills, your earning power, which is your single greatest financial asset, starts to depreciate. Skills become automated, industries get disrupted, complacency is the enemy.
So he pushed for this massive cultural shift from being a company of know-it-alls to a company of learn-it-alls.
And that's not just some fluffy corporate slogan. A know-it-all culture is about defending your existing status and knowledge. A learn-it-all culture is about curiosity and renewal. For Microsoft, it was a survival strategy. For an individual, it's the same thing.
The goal is adaptation, building that personal habit of scan the environment, learn a new skill, apply it, get feedback, and repeat.
So to make that concrete, the first tactic is a quarterly skill depreciation check. You have to ask yourself, which parts of my job are getting easier to automate or outsource? And then you immediately start learning the adjacent skill that can't be automated.
And you need a personal syllabus, a learn-it-all syllabus.
With 3 tracks. Track 1, constantly get deeper in your core craft. Track 2, master the timeless basics of money, the Bogle and Thorpe stuff. And track 3, always be learning one frontier skill: AI, data analytics, whatever's emerging in your field. That's where your future opportunities will come from.
You also talk about the need to practice unlearning.
This is huge. We focus on what to learn, But we also have to consciously discard old bad habits, whether that's impulsive trading or just avoiding looking at your finances. You have to actively decide to stop doing the things that are holding you back.
And finally, ship small. Don't wait until you feel like an expert.
No, learn like a software team. Do small projects. Apply what you're learning immediately in a low-stakes way. That's how you build real competence, not just theoretical knowledge.
But even the most dedicated learn-it-all has blind spots. You can't see your own label from inside the jar. And that brings us to the final piece of the puzzle. Compounding your knowledge with other people, just like Benjamin Franklin did.
Exactly. We're in Philadelphia, 1727. Ben Franklin is only 21 years old. He's ambitious, he's smart, but he recognizes a fundamental danger of working alone. It's just too easy to get lazy or reckless or to fall for your own bad ideas.
So he didn't go find a mentor. He built a peer group, the Junto.
Or the Leather Apron Club. It was a small group of other artisans and tradesmen, and they met every week, not just to hang out, but with a very specific structured agenda for mutual improvement. They debated morals, politics, science, and the very practical realities of running a business and managing money.
So this was a learning machine made of people, and it led to real-world outcomes.
Big ones. The ideas that came out of the Junto led to the first lending library, better fire protection for the city. And Franklin himself was able to retire at 42, not just because he was frugal, but because he had built this incredible network of knowledge and trust that created opportunities for him.
The principle is so clear. Trying to build wealth as a solo sport is just incredibly risky. You need a learning circle to correct your mistakes faster, ask you better questions, and just hold you to a higher standard.
In that room, with that group, you can't get away with the lazy excuses you tell yourself when you're alone. Someone will call you on it. You pay for the lesson with a little bit of ego in a meeting instead of with a lot of money in the real world.
Yeah. So if someone listening wants to build their own modern Junto, what are the rules?
First, keep it small. 3 to 6 people is ideal.
Yeah.
And they have to be serious, committed, and this is key diverse in their skills. You don't want a group of 6 people who all do the same thing.
And you need a fixed agenda. This isn't just a casual chat.
A rigid agenda is essential. 10 minutes on recent wins, 10 minutes on tough lessons learned, 20 minutes focused on one person's specific challenge or decision, and 10 minutes on commitments for the next week. It has to be practical.
You also say you have to make the learning visible.
Every member should share one thing they learned that week that actually caused them to change a decision. It connects the reading to real-world action. And you have to focus on practicality. Talk about why businesses and budgets fail, not just what makes them succeed. Failure analysis is the most valuable part.
And it has to end with commitments, not just good vibes.
Absolutely. Everyone leaves with one specific, measurable action they are accountable for completing before the next meeting. That public accountability is the glue that makes the whole thing work.
If you want compounding wealth, you need compounding conversations.
And that really ties it all together. We've seen that this path to durable wealth, it's not built on secrets. It's built on systems.
Right. We saw the need for relentless input from Buffett and the need to turn that input into a feedback loop with Simons. We learned to audit our own certainty from Dalio and the power of teaching yourself the mechanics from Thorpe.
We saw the timeless edge of prioritizing Bogle's simple evidence over complex narratives, the need to stay a learn-it-all like Nadella, and finally, the exponential power of building that external accountability with Franklin's Junto.
The whole engine is really simple when you boil it down. Compound your knowledge first before you even worry about compounding your money. If you refuse to question your beliefs, your bank statement will do it for you.
The fastest way to build wealth really is just to become harder to fool. And so, we'll leave you with this final thought to chew on. If you took Ed Thorpe's challenge, if you really dedicated 2 summers to a deep, instrumental study of the one financial area that scares you the most, what specific skill would you gain? And how would that one skill fundamentally change your power, your confidence, and your risk tolerance for the next 30 years?
A deep dive into the systems of the masters. We hope this helps you build your own engine for success.